Welcome to video 7A on interest and dividends. So I'm hoping the sound quality is going to be better. I've scrapped my headset. Not sure exactly what happened to that thing, but it's like I had my scuba set on. So I apologize for the sound quality. I hope that we don't run into those problems again. All right, so we typically cover learning objectives at the start of a new chapter. So let's do that for chapter 7. We're going to talk about portfolio income and how that's taxed. And again, we get to enjoy a fairly light touch. And one of the reasons we do that is because portfolio income is not a common form of business income. This is a much more common form for individuals. We have a separate tax course on individuals, but we cover it enough so that you can be dangerous. We're going to talk about the tax consequences of capital gains and losses. These do occur in the business setting, so we need to make sure we've covered that exhaustively. And we'll loop back around in the next module and really hit on that hard again. And then we're going to talk about what is undoubtedly one of the most complex areas of the tax law. For those of you that had me for 503, we went through this. You better believe we do it again because this is a really difficult area to understand, but it has to do with how basis at risk and the passive loss limitations can apply to certain forms of income. And it says income, but it's really losses that we're talking about. Okay, let's get started. So what are investments? When we think about portfolio income, we think about that coming from investments. So that could be like investments in stocks, bonds, things that are a bit more interesting like futures, forwards, and options. It could be commodities, it could be annuities, it could be mutual funds or hedge funds. And then you could really get bizarre and go with things like oil and gas leasing partnerships. Or you could just be a silent partner in a business, right? You could simply take a passive role. So you come to the table with equity and you just allow management to use your equity and make money for you. And that doesn't have to be in the form of a publicly traded stock, for example. Okay, so the types of income, we talked about this before, right? How we split income into all these different forms. For this chapter, we're largely going to talk about portfolio income. And we'll refer to that as capital gains and losses, dividends, interest, annuities, royalties, and then business forms of income, which can be either passive, which means the taxpayer does not materially participate in that business activity, or active business income in which the taxpayer does materially participate. So, for example, a salaried employee, wage-paid employee, they materially participate. Self-employment generally results in material participation. So we're going to split down why those are important later on. So again, when you invest, you have many different choices of investment, right? So from a portfolio income perspective, the two bigs are interest and dividends. And so we know interest could be tax exempt if it's municipal bonds. Certain life insurance can be tax exempt. Or it could be investment in a business, right? So that's the opposite of this portfolio income. So active would be a pizza shop you own and operate, and passive would be, let's say, a partnership investment into a building in which you don't materially participate in the management of the building. So portfolio interest is generally taxed at ordinary rates. So recall that we've discussed briefly back in how to calculate tax that there can be a different rate structure between ordinary income and other forms of preferential income. For example, qualified dividends or long-term capital gains. And we'll spend some more time on that today. So that's generally earned when received for a cash basis taxpayer. Interest otherwise is earned over time. So you often think about interest as just accruing ratably over time. U.S. Treasury notes and bonds are taxed federally, but they're not taxed at the state level generally for income tax. That's not always true, but it's generally true. So the other form of portfolio income that's pretty common is dividends. And dividends come in two flavors. They're either qualified or non-qualified. And qualified dividends enjoy a preferential rate, whereas non-qualified dividends are simply treated as other forms of ordinary income. So in order to be a qualified dividend, it must be paid by a domestic or certain other foreign corporations, and the stock has to have been held for a certain length of time. And we're not going to get into the details on what it takes to be a qualified dividend, but rather what is the treatment. So these are subject to preferential tax rates. We've seen these before, right? So it's 15% for most taxpayers, but you can see that there's a rate table over here on the right side of the page, and it breaks down the different capital gains brackets, right? So it's 0% for, let's take an unmarried individual, from $0 to $39,375. For married filing joint, 0 to double that amount, or $78,750. And then after you become a high income taxpayer, so for a single taxpayer, $434,550, married filing joint, $488,850, the tax rate on qualified dividends actually goes to 20%. Okay, so again, 15% for most taxpayers. You can see that's a pretty big bracket range. And the reality is that most people whose income, taxable income, is under $78,000, they probably don't have a lot of dividend income anyway. It's not that they could have none, but they certainly don't have a lot. Okay, so you can, of course, measure the after-tax rate of return. If you assume an 8% before-tax rate of return, you would typically just take pre-tax, multiply that by 1 minus the tax rate, and get the after-tax rate. And again, we talked about that in the previous module. And to reiterate, non-qualified divs are taxed as ordinary income. All right. So qualified dividend taxation, let's go through some examples. So Lisa is a single taxpayer, and she receives qualified dividends of $3,000, and her other taxable income is $40,000. So we would look at her. She's single, so she's unmarried. Her capital gains are over $40,000, right? Because you lump together her two forms of income. So once we include her other taxable income of $40,000, she is into the 15% bracket, and she would pay at 15%. Let's compare that to Maggie, who's single, and her other taxable income is only $25,000. So you can see that 25 plus 3, that puts her well under the $39,375. And as a result, Maggie would pay at 0%. Now, there's an interaction between the amount of ordinary taxable income you have and when the preferred rates kick in. So when you pay at 0.15, we cover that in Accounting 503, and I think it's best left for there because it really is an individual-only issue. So the good news is that brings us to the end of video 7A. Thanks for watching.